Welcome to the Deep Dive. We're here to help you cut through all the noise, get you the essential insights you need to be, truly well-informed.
Yeah, without getting bogged down in jargon or feeling overwhelmed. Think of it as your shortcut.
Exactly. And today, we're diving deep into a really foundational book for investors. William Bernstein's The Four Pillars of Investing came out in 2002, been updated since then, and it's just, well, it's essential reading.
It really is. And what's great about Bernstein is he doesn't just give you hot stock tips. It's a whole framework.
Right.
He argues pretty convincingly, I think, that successful investing isn't just about technical stuff. It's about understanding history, your own psychology, and maybe crucially, how the financial industry actually works.
That's our mission today, then, to pull out the most important nuggets from Bernstein for you. He breaks it down into these four pillars: theory, history, psychology, and business.
Mm-hmm.
We're going to unpack each one, see how they fit together to build a really solid investment philosophy.
And understanding this stuff, it's not just academic, right? It's really practical. It's about building your financial future, avoiding common mistakes.
Yeah, those pitfalls that trip so many people up.
Exactly. And making decisions that actually matter for your long-term wealth. It empowers you.
Okay, let's get into that first pillar, investment theory. This is the bedrock, right? The sort of fundamental rules of the game.
That's a good way to put it. It's the how things work part.
Yeah.
Bernstein talks a lot about modern portfolio theory, or MPT.
Sounds complicated, but
Well, the core idea is actually pretty simple and powerful. It's that risk and return are linked. You want higher expected returns. You generally have to accept more risk, more volatility.
the no free lunch principle?
Precisely. No free lunch. But MPT also shows how you can be smart about that risk by combining different assets, stocks, bonds, international, domestic things that don't move perfectly together. You can actually build a portfolio that gives you a better return for the risk you're taking, or the same return with less risk. It's about optimizing, getting the most bang for your risk buck, so to speak.
So theory says risk and return go hand in hand, but Bernstein seems to think something else is even more important. He really hammers on asset allocation.
Oh, absolutely.
Why is deciding how much goes into stocks versus bonds, for example, more critical than picking the right stock?
Because that mix, that allocation between broad categories is what overwhelmingly drives your long-term results and your risk level. Individual stocks, they can go anywhere, wildly unpredictable.
Right.
But the blend of assets, that's the main determinant. Bernstein is adamant. Asset allocation is the single most important investment decision you make. Forget trying to find the next Amazon. Focus on getting the mix right for you.
It's like choosing the right ingredients for the meal, rather than obsessing over one specific spice.
That's a great analogy, yeah. Get the basic ingredients right, your stock bond other mix, and you're way ahead of the game.
And that mix naturally involves diversification. We hear that word all the time, but what's the real power behind it?
It's your main line of defense, really, against the unexpected. If you own lots of different things, different types of stocks, bonds, different countries, different industries, you're spreading the risk.
So if one area gets hammered,
Exactly. If tech stocks crash, maybe your bonds hold up or your international stocks do okay, it smooths the ride. It prevents one single bad event, like a company going bankrupt or one sector collapsing, from completely derailing your whole plan.
it sounds like common sense, but
But it's amazing how many people don't do it properly. They end up concentrated in just a few things.
which leads us nicely into Bernstein's take on passive versus active investing. He's a big fan of index funds, ETFs, the low-cost stuff.
Huge fan. And his reasoning is brutally simple. Passive investing, just buying the market through these low-cost funds, usually beats active management, trying to pick winners over the long run.
And the main reason is costs.
Costs. It's almost entirely down to costs. They matter immensely. Think about it. Even a 1% extra fee per year might sound small.
Doesn't seem like much.
But compound that over 20, 30 years, it takes a massive bite out of your potential returns. Maybe 15%, 20%, or even more of your final nest egg just vanishes into fees.
Wow.
And the vast majority of active managers don't even beat the market before fees, let alone after. So passive lets your money work for you, not for the fund manager.
Okay, so theory gives us the mechanics, how it should work. But markets aren't just equations, are they? They involve people.
Billions of people making decisions, often emotional ones. And that's where the second pillar, investment history, becomes so vital.
Right, because history shows us how theory plays out in the real, messy world.
Exactly. Bernstein uses history to show these recurring cycles. Booms, busts, manias, crashes, they happen again and again. Markets aren't smooth lines going up. They're full of these dramatic swings driven by human emotion overlaying those theories.
And he gives some amazing examples, doesn't he? Like the Dutch tulip mania.
Oh yeah, back in the 1630s, people paying more for a single tulip bulb than for a house. Pure speculation. Then crash.
And the South Sea bubble in the 1700s?
Same story, different asset. Huge hype about trading riches, fortunes made on paper, then wiped out. Total collapse, ruined thousands.
And more recently.
Well, there's the Great Depression, obviously a defining event. And the tech bubble of the late 90s. Remember that? Companies with zero profits valued in the billions.
I do indeed. Seems so obvious in hindsight.
That's the key lesson from history. Investors keep making the same mistakes. We get swept up in the euphoria, overestimate the potential returns, completely ignore the risks.
Until it's too late.
Right. Then panic sets in. History teaches us these cycles are driven by predictable human behavior.
So the point isn't to try and avoid crashes, because history says they're inevitable.
You can't avoid them, and trying to time them, jumping in and out, that usually fails too.
So what do?
You anticipate them, you understand they will happen, and you build a portfolio using diversification and the right asset allocation that can endure them. You ride them out, stick to your plan. Don't try to be smarter than the cycle.
Which leads perfectly into pillar number 3, maybe the toughest one, investment psychology.
Yeah, this is where Bernstein basically says the biggest enemy is often staring back at you from the mirror.
Ouch. It's us, our own brains.
Largely, yes. Our own behavioral biases, the quirks in our thinking, constantly tempt us into making bad decisions. It's a battle against our own nature.
Okay, let's unpack some of those biases he talks about, like overconfidence.
Oh, that's a big one. Believing you're smarter than average, that you can pick the winning stocks or time the market perfectly.
Which almost nobody can do consistently.
Exactly. Even most professionals can't. But we think we can. That leads to excessive trading, taking on too much risk. It's dangerous.
Then there's loss aversion. What's that about?
This one's deep-seated. Psychologically, the pain of losing a certain amount of money feels roughly twice as bad as the pleasure of gaining the same amount.
Oh, really? Twice as bad.
Studies show that consistently. So what do? We hang on to losing investments way too long, hoping they'll just get back to even because selling locks in that painful loss.
Or sell winners too soon.
Right. Just to lock in a small gain and avoid the fear of it dropping back down, we let the fear of loss dictate our actions, often irrationally.
And what about recency bias?
That's assuming whatever's happening now will keep happening indefinitely. Stocks have been going up. We think they'll go up forever, so we pile in at the top.
And when they're crashing?
We feel like it's the end of the world, that it'll go to zero, so people panic sell near the bottom, locking in those losses. We overweight recent events in our decision-making.
It's easy to see how that fuels herding behavior then.
Absolutely. Everyone else is buying. Fear of missing out kicks in, so you jump in too, often without thinking. Everyone's selling. Fear grips you, so you sell too, often at the worst possible time. Following the crowd feels safe, but often leads you right over the cliff.
So, theory, history, psychology. It paints a pretty challenging picture.
How does Bernstein say we fight back against our own psychology?
His solution is, well, it sounds simple, but it's hard to do. Discipline and automation.
Okay.
First, create a sensible long-term investment plan based on those principles of theory, diversification, low costs, proper asset allocation. Write it down.
And then the hard part.
And then stick to it religiously. Through thick and thin, ignore the noise. Ignore your gut feelings when the market goes crazy.
Easier said than done when everyone's panicking.
Absolutely.
Yeah.
Which is why he strongly advocates automating your investing. Set up regular automatic contributions to your chosen low-cost funds. Take the decision-making out of your hands as much as possible. Let the plan run on autopilot.
Remove the emotion. Let the system work. That's the goal. Minimize the opportunities for your biased brain to mess things up.
Okay, that brings us to the 4th pillar. The investment business itself. This is where Bernstein gets a bit critical of the industry.
You could say that, yeah. He basically argues that large parts of the financial industry aren't necessarily set up to serve your best interests. Their business model often involves profiting at your expense.
How so? What does he mean by the Wall Street machine?
Well, think about how many advisors, brokers, and active fund managers make money. often through commissions on trades or high management fees on funds or selling complex products.
Right, the fees we talked about earlier.
Exactly. Those fees directly reduce your returns. And often the advice or products they push might generate more income for them than they provide actual value for you. Their incentives aren't always aligned with yours.
So their goal isn't necessarily maximizing my wealth,
But maximizing their own revenue, which often comes from your wealth through those fees and commissions. Bernstein argues they often make money whether you make money or not, and complex, opaque products, often designed to hide high fees and benefit the seller more than the buyer.
that sounds pretty cynical.
It is realistic, though. You need to understand the game. So what's his advice for navigating this?
Be skeptical.
Definitely be skeptical. Ask questions. Specifically, avoid high-fee mutual funds. Be wary of brokers pushing specific products. Ask how they get paid. Understand potential conflicts of interest.
Look for transparency.
Less. And simplicity. Prefer low-cost, transparent investment vehicles. Index funds are the prime example. He often mentions Vanguard specifically because their unique mutual ownership structure helps align their interests with investors. Low costs are built into their DNA.
Okay, so we've covered theory, history, psychology, and the business. Let's try and pull it all together.
Yeah.
What are the core takeaways from Bernstein's 4 pillars for you, the listener?
I think the first big one is just patience. Markets reward long-term, disciplined investors. Trying to get rich quick usually backfires. Stay the course.
And diversification is your protection. Don't put all your eggs in one basket. Spread the risk widely.
Absolutely. Own the whole haystack, not just one needle. And third, maybe the most practical advice. Costs matter immensely. Those fees are relentless. Keep them as low as possible. It's the easiest win.
Then stay humble. Don't think you can outsmart the market consistently. It's incredibly hard. Just aim to capture market returns cheaply.
And remember, history repeats, or at least rhymes. Bubbles, crashes, they're part of the deal. Expect them, prepare for them, don't panic when they arrive.
Crucially, behavior is key. Mastering your own psychology, sticking to your plan even when it feels wrong, that's maybe half the battle, or more.
It really might be. And finally, for most people, DIY investing works best. A simple portfolio of low-cost index funds is likely to outperform most complex strategies and most professionals, especially after fees. Keep it simple.
He even sketches out a simple portfolio, doesn't he? Like a starting point.
Yeah, something balanced, maybe like 25% U.S. stocks, 25% international stocks, 25% bonds, high quality, shorter term usually, and maybe 25% in something else like real estate or TPS for diversification.
The exact mix depends on you, your age, risk tolerance.
Of course. But the philosophy is key. Broad diversification, low cost, rebalance periodically, and stick with it.
So when you boil it all down, Bernstein's message seems to be, successful investing isn't about genius.
Not really. It's simple in theory, but it's not easy in practice because of our psychology and the way the industry works.
It's less about finding the magic bullet.
And much more about consistently avoiding the big, common mistakes. Control costs, diversify, manage your behavior, understand history, be wary of the industry's conflicts.
If you can do those things, you're putting the odds significantly in your favor.
That's the essence of it. It empowers you to build wealth steadily and avoid the disasters.
It's a really powerful framework. Okay, so here's something to think about after listening to all this. Considering everything we've unpacked, theory, history, psychology, the business, what aspect of your own investing psychology, your own behavior, might be the biggest hurdle, the most challenging pillar for you to actually master?
Yeah, and maybe how could you start putting some guardrails in place, like Bernstein suggests, to address it in your own financial life?
Food for thought. That's it for this deep dive. Thanks for joining us.